if your first round of fundraising, you have good investors and good valuation, you can expect you will have high probability to have the same in the future.
Don't be afraid to kind of test different ideas and have people not buy. I think that's the biggest underlying problem, or one of them, is founders are afraid that if they put something out there, then they'll get negative feedback or negative result. So they don't do it at all, but you need to get data.
What's something that you don't get to talk about often, that you just think, gosh, I wish there was a discussion on this so founders didn't do this? Maybe in a pitch, if you could talk about it, or in a different interaction. What's something else we can dig our teeth into?
You have a lot of subsidies or alternative funding solutions that are in the market that can actually help you to push your business development efforts to generate more tractions. And this is really important because more you generate tractions at the beginning, more you will have numbers to show to your potential investors. And this will help you to first find better investors and also have a better valuation. And at the end of the day, this is a snowball effect. If your first round of fundraising, you have good investors and good valuation, you can expect you will have high probability to have the same in the future. You have a lot of solutions in the market that can help you. For example, if you are an e-commerce solution or a SaaS, you can work with some credit loan digital startups such as Silver, Ritmo, that are advancing you the money and plugging themselves to your Google AdWords or Facebook ads accounts. And this helps you to not raise funds too quickly and not dilute yourself, but rather, push your tractions and then be able to raise more at a higher valuation with better investors.
I think the equity crowdfunding space is pretty exciting, and you don't even have to give equity away, I think, especially for startups that qualify for it, just the crowdfunding period, where they're going out on things like Kickstarter and finding customers first, customers before spending all the money to build a new product. I know there are very successful companies that go out and test new products by running very good Kickstarter campaigns, and that way they get to prove that they're successful before they go and waste the money. Is that the kind of direction that you were thinking, or were you thinking of other alternative funding routes?
No, actually, I was not really thinking about crowdfunding. So, you can ask my peers, but actually, in the VC space, a lot of VCs are against startups that already raised through crowdfundings. I was more thinking about other alternative funding solutions, such as these startups like the one I've mentioned, Ritmo, Capchase, and Silver, that can help you to actually, instead of raising money through private investors, to receive loans for specific business models. So in that case, it's for online businesses, and they plug themselves into your Facebook or Google ad accounts, and like this, they can track and give you the money over time. It's pretty well done. And this, by receiving this money and then performing better and having more tractions, then in the future, you can actually raise through VC funds at a better valuation and with better investment. That's just an example out of many. But my overall, let's say, advice was more to no rush on the VC fund. I would rather focus first on the tech, on the references and tractions, and then raise funds through private investors instead of doing the other way around.
I wrote down a few things that I think founders generally should think about or be aware about. One, to hammer on Thomas's point, please find a way to prove demand or feasibility that's meaningful. I think that's probably the most important thing a founder can do to de-risk the investment from the investor's perspective.
Can you explain how to do that and what you mean when you say that, just for folks who don't fully understand?
Sure, it can mean a variety of things. It can mean signed LOIs for your product. It can mean real revenue, immediate or ARR, however is appropriate to measure that. Customer deposits, back orders, anything that's going to prove the top line. Obviously, if you're in a deep tech space, patents can be helpful. Other forms of like advancing drugs through clinical trials. Hey, we made it through phase 1. anything that shows the viability of your product to get to market and to attract and capture demand. And doing that in mini experiments is helpful. So sometimes folks are tempted to spend a lot of money on like a market research project and get some data, whereas they're probably better off just buying AdWords and seeing what the cost per acquisition is of a customer for their website. So keep it simple and keep it direct. Don't be in your experiments, and don't be afraid to kind of test different ideas and have people not buy. I think that's the biggest underlying problem, or one of them, is founders are afraid that if they put something out there, then they'll get negative feedback or negative result. So they don't do it at all, but you need to get data.